If you're a self-employed professional or have a single member LLC, this is for you. In this video, we're going to cover how much tax you will pay if you make $100,000, $500,000, and even $1 million on your Schedule C tax return. This video is for real estate agents, freelancers, coaches, consultants, independent earners of any type, and single member LLC owners who file a Schedule C on their tax return. We're going to cover the Schedule C basics. What is it? How does it work? How does the income flow to your individual tax return? We're going to go through 3 scenarios where an individual earns $100,000, $500,000, and then $1 million, again, as an independent consultant or freelancer. We'll close it out with my top tips for saving tax as a Schedule C earner. Before we get started, if you're enjoying these videos, hit the subscribe button. It helps the YouTube algorithm, and it helps us bring you the best possible videos to help you save and make more money. So first, we'll start with the Schedule C basics. What is a Schedule C? How does it work? And this is very important if this is your first year as an independent contractor, freelancer, coach, or consultant. Basically, your Schedule C is an IRS name for the profit and loss statement that you actually create and file with your annual tax return. Its purpose is to calculate the net income that generates the net taxable income on your personal tax return. As you can see, it's basically a one-page document that starts with all of your revenues on top, your cost of goods sold, if you have those, down towards the middle, and all of your operating expenses like advertising, travel, professional fees, office expenses, software, vehicle, meals, anything and everything related to actually generating a profit for your business, you can then take as an ordinary business deduction. What's left over at the bottom is your net income, and that number will ultimately drive how much self-employment tax and income tax that you and your spouse will pay on your individual tax return. So you actually don't file a Schedule C as a separate tax return. It's simply another couple of pages added to the back of your individual tax return or Form 1040. And your tax professional will definitely charge you a bit more to prepare the Schedule C, but you can reduce that cost if you simply do the work of providing your accountant with a profit and loss statement. And you can generate that profit and loss by going into your QuickBooks or Xero or accounting data and providing it to your accountant at tax time. So we're going to run a few scenarios, and the assumptions that we're going to use right now are pretty basic. We're not going to get into itemized deductions or dependents and filing statuses. We're going to keep it very, very basic so you can simply see how your tax rate unfortunately goes up and how some of the deductions actually go down as you earn more income on your Schedule C. So in these scenarios, we're going to assume the following. We're only going to look at the federal tax return for the year 2020 using 2020 tax rates. We're then going to generate a $100,000 income Schedule C, a $500,000 income Schedule C, and then a $1 million income Schedule C. We're going to have zero other income like no dividends, capital gains. We're going to assume a single filing status, a standard deduction of $12,400. We're going to try to maximize the QBI or qualified business income deduction. And we're really not going to assume any other credits or deductions on the individual tax return. Just a straight Schedule C, and that's really all the income that this particular person is going to generate. So your personal scenario will be much different than what this is. This is for illustrative purposes only. So for this person who earned a $100,000 net income on their Schedule C, here's how it looks. Towards the top, you can see the $100,000 net income coming from the Schedule C, which starts on line 8 and goes to line 9 of the individual tax return. There are a couple of adjustments, primarily the deduction for 1/2 of the self-employment tax that flows to the individual tax return. That creates the adjusted gross income, which then is reduced by the standard deduction for a single person in 2020, which is $12,400. This scenario generates a QBI deduction of 20% of the available income, and there actually is an income limitation there, but that reduces the income by an additional $16,107. The resulting taxable income is $64,428, and with no other deductions or credits, the total tax that this person will pay is $24,093. And this creates an average tax rate of 24.1%. So if you're married and have dependents and you have very high itemized deductions, then your income will probably be lower, and therefore your tax will be lower than this scenario. But the end result is that this person owes $24,000 to the federal government and additional tax to their state if they live in a taxable state. In this scenario, we have a $500,000 Schedule C, and keep note that there's a few things that have changed, including the average tax rate and the QBI deduction. Now, this person can still deduct 1/2 of the self-employment tax, but due to the income restrictions calculations of the QBI deduction and the type of business that we've assumed this person is in, they actually get 0 QBI deduction at all. Now, this person ends up generating a net taxable income of about $472,000. When you apply the various federal tax rates to this income, the total tax bill comes to $172,945. And that is a 34.6% average federal tax rate. A lot higher than if you're making $100,000, right? Now, in this scenario, we have a $1 million net income Schedule C that flows to the individual tax return. And if you think this is outrageous, it's really not. Plenty of real estate agents, coaches, consultants, online earners, even freelancers make over $1 million as single member LLCs or even independent contractors. And if you're expecting the average tax rate to go up, it definitely does. Here's how it looks. If you include the $12,400 standard deduction for this single person's tax return, the taxable income ends up at $965,000. With little to no other deductions or credits against this income, unfortunately, this person is going to pay a boatload of federal tax. The final tax bill comes to about $372,000 straight to the U.S. Treasury, which is a 37.2% average tax rate. So in summary, if we compare the three side by side, here's how it looks. The $100,000 earner paid about 24.1% average federal tax to the U.S. government. The $500,000 earner paid 34.6% average tax rate to the federal government, and the $1 million earner paid 37.2% average federal tax to the U.S. government. And the other observations are that as self-employment income increases, the self-employment tax obviously also increases, the QBI deduction decreases, and the average tax rate goes straight up in line with income. So while it really stinks to have to pay so much tax to the federal government, don't forget you also have to pay tax to your state government. There's a reason why a lot of people are moving to tax-free states like Florida or Texas as they make more income and don't have to be tied to a particular city or state anymore. Simply because if you start earning $500,000 to $1 million a year and your state is charging you an additional 5 to 9% in tax, you're paying tens of thousands of dollars more to your state that you really don't have to if you can move to another state and not pay any income tax. If you're frustrated with your taxes as a Schedule C or a self-employed earner, check out the tax guide by clicking the link below. There's about 60 strategies to save money by reducing your tax and use some of the credits, deductions, and loopholes available to you. Also, don't forget that you have quarterly estimates to do as a self-employed earner. And always remember, if you can't pay the tax, meaning you don't have the cash to pay your quarterly estimates at the time, or you don't have the cash to pay the balance due when your tax return comes due, the worst thing you can do is not file your tax return. That's right, the penalties go up literally 10 times if you don't file your tax return on time and you have a balance due. So when in doubt, file your extension or file your tax return and make a payment plan with the IRS or your state to pay the taxes over time. Otherwise, you're going to pay a lot of unneeded penalties and interest because you didn't file your tax return on time. I hope this has been helpful to you. Hit the subscribe button so we can continue giving you great videos, and we'll see you in the next one.